I guarantee that if you watch these next 54 minutes, you are going to become a better trader. I'm simply just going to give you the right information so that you can improve your skill of reading the charts. This was a private recorded group mentorship session that I'm giving to you guys for free. So with that being said, make sure you take advantage of it, implement these concepts that I'm going to teach you, and enjoy this training session.
Liquidity, like in simplest terms, when you think of liquidity, I just want you to think of other people, other orders, other people placing trades. Because the thing with trading, the thing with the industry is this is a zero-sum game. So every time you're making money, somebody's losing money. Every time you're taking a buy because you think prices are going to go higher, the only reason you're able to take that buy is because someone somewhere else sold their order at that point. So it's like someone sells, you're buying, someone sells, you're buying, someone sells, you're buying. So when you're losing money and you just lost that trade, somebody was making money at the end of that trade. You get what I'm saying? So it's a zero-sum game. It's just either. So when you think of liquidity, liquidity is just other people with orders just like us. They could be regular retail people, banks, institutions, but nonetheless, wherever there is stop losses, wherever there is orders, that's going to be liquidity, because that's where the market is ideally running to. Because the misconception that a lot of people have when it comes to trading is that the market just goes up and down to support and resistance, is up and down, when in reality the market does a whole bunch of this, has a move like that, stops them all out, then sometimes goes higher, or sometimes comes all the way down here, stops them all out, comes a little bit higher, and goes lower. It's not as simple as just up down up down up down. You got to understand that there's certain areas that are going to be higher probability, that are going to make more sense to put into positions. And as you can see from the trades that I've caught the last, I would say, 2 weeks, using the same concepts every single time, the same concepts I've been teaching you guys, they happen every week. And it's a different day every week that these candles are forming. So the fact that it keeps happening and the same thing keeps happening, it's just say enough. The market is 100% manipulated and rigged. Shit is big rigged. World is really corrupt. Because you got to understand, why is it rigged? Because it's rigged to essentially make it so majority people never make money doing it. So it's just like anything else. It's just like having a job. The whole point of a job, in a sense, is to pay you little enough, but just enough to be able to get by, to where you would just get comfortable and do that. And then essentially you would start being a part of the world, the economy. You'll be a part of their system. Same thing for this. There we go, Mondi. Yeah. You hear? You just missed a little conspiracy talk. Man, never mind. It was supposed to make you want to be here. But are we about to? So did you hear what I said we were gonna go over? Yeah. I said you heard what I said we were gonna go over? Yeah, we're gonna go over liquidity. I'm gonna talk on sessions. I'm gonna talk on the Fibonacci, which is the fib. I'm also gonna talk about these trades that I took this week, so we could just kind of dissect it and go over the reasoning. But first things first, we're just gonna get a brief overlook of liquidity. Like I said, liquidity is just orders resting in the market, and where those orders a lot of the times are gonna be. And I'm asking Anna. I said, so if liquidity is a whole bunch of orders of people with stop losses, where are these orders a lot of the times going to be? Nah, not necessarily what time. Time is a very important aspect. But say, for example, if you know what liquidity is, now where is the liquidity? Yeah, like on the charts, like anything. When it comes to me asking anything, but these questions is all gonna be strictly charts. Yeah, everywhere, but where specifically? You guys know it. There we go. The highs and lows. That's the main thing. That's why we pay attention to watching to see what price does at these highs or lows, because we know that above every high and every low, there's stop losses, there's orders, because we know, even though we might not have orders in there, we know that that's how majority of people are thinking. Majority of people have stop losses above old highs, below old lows, above old highs, below old lows. And as you can see, when you look at it in this perspective, there's a whole bunch of liquidity. Like Amandi said, it's everywhere. So now you got to understand where is the high probability liquidity going to be. And that's when the time comes into play. Because like I said many times before, time is everything. Without timing, nothing else matters. You have the perfect trade, you can have the perfect everything setting up, but if it's not within the right time, it may not even move. If it's not within that right time, it may not give you what you're looking for. So we're just going to keep this portion of it simple because it's something we've already gone over a lot. But we're going to go into a few of the trades so I can explain liquidity. So where was the main thing? So you guys remember what fair value gaps are? If I were to ask you to explain to me what a fair value gap is, Amandi, how would you explain it? So when you think of a fair value gap, you want to think of 3 consecutive candles in one direction, right? When you get 3 consecutive candles in one direction, what it does a lot of the time is you want to pay attention to see if there is a gap in between the first and the third candle. Meaning, is there a gap between the first and the third's wick? And that a lot of the time is created when there's a lot of volume. Because when you get a large candle, for example, like this one right here, which is a big ass candle, those are the ones that usually leave very easily spotted gaps. Like this one right here, it would be very hard to trade a gap like this because it's so wide. It could do whatever within this whole gap. Like this right here would be the gap. And why was that the gap? Because if I were to zoom in, out of this first candle, the second candle, and the third candle, the first candle's high and the third candle's low. You can see that they just don't touch. It's just as simple as that. When you want to find a gap, you can simply just look at 3 candles. If the first candle's wick, or if the first candle just doesn't touch the third candle at all, it's usually a gap. Now once you understand that, you're going to be able to see that there's gaps everywhere. It's just like liquidity. There's going to be gaps everywhere. Not necessarily it's going to be a high or a low, because if I were to turn this chart upside down, it wouldn't be the low high no more. It would just be the low. But you just want to always look at the first candle, second candle, third candle. So it's either going to be the first candle's high or low with the third candle's high or low, vice versa. You get what I'm saying? But it's only going to be the first candle's high or low or the third candle's high or low, because there's only 2 directions. But the concept is the same either way. Once you understand it for one direction, it's literally just flipping it upside down, and then you understand it for the other direction. So first 3 candles, first candle's body, wick. If it doesn't touch anything on the third candle, then it's usually a gap. Now, finding the gaps are easy. If I were to go into the chart just like this, we could find a gap right here. There's a gap right here. There's a gap right here. There's gaps everywhere. It's just like liquidity. We know that there's liquidity at every high and low. But now we got to understand, where is the high probability fair value gap is going to be. Where are the high probability highs and lows? Because you can have all of them, but we want to put ourselves behind positions that are going to be high probability. We want to put ourselves in situations that we're more than likely going to win versus more than likely going to lose. We just want to put ourselves in a better situation, because at the end of the day, we're risking money. We're risking money to make more money. So we want to put our money in the best conditions and environment to succeed. And that's going to be done by understanding where high probability highs and lows are, understanding what are high probability fair value gaps. So when you want to think of high probability highs and lows, this is easy in my opinion. You're going to want to basically pay attention to the higher time frame. So when I say the higher time frame, highs or lows, you would pay attention to previous days highs or lows, which is something I've already talked to you guys about a lot. But that same concept goes even higher. Instead of the previous day, the previous week highs or lows, it's the same thing. You can go to the monthly. Hold on. The previous month high or low. It's just the same thing all the way higher time frame. And you can go lower time frame, but if the higher time frame is going to be higher probability, what do you think the lower time frame is? Lower probability. So the lower time frame is going to have way more setups. It's going to have way more things happening at once. So now you got to understand, with all that happening, the insignificance of each thing is going to be more likely versus the higher time frame. There's going to be less going on. It's going to be more condensed, and it's going to be showing you a broader picture overall. So one thing you got to understand with understanding where higher probability highs or lows is, it a lot of the time is going to be the higher time frame, because we know above those higher time frames, highs or lows, such as the previous day's high or low, is going to be a lot of orders. It's going to be majority of orders. So that's why a lot of the time at those areas, that's where price tends to have those false break types of moves. And what is a false break? A false breakout essentially is just when price creates an old high or low somewhere, runs that high, and then has a reversal move. And this is where we like to capitalize on this move right up here, these types of moves, because we know that the basis of this move is basically understanding that there was liquidity above this high or low. And ideally, if this all happened at the right time, so say price ran that high and started to have a rejection at the right time, these are the moves that we like to catch. Now you can also put into things such as, did price trade into a fair value gap? But this concept by itself is just keeping it simple. Is easier said than done, because now you got to understand, you got to learn to see it in live conditions. That's why I gave you guys try to get the demo account, because it's one thing for me to show you after the fact versus trying to see it while it's happening. That's why you got to get experience. That's the main thing. But you guys got a basis idea of liquidity. The main thing with liquidity is you guys got to actually use it. So I'm just going to move on to the next topic right now. But we're going to talk about more on fair value gaps. So what do you think will make a fair value gap higher probability? Not small trades necessarily, but higher time frame for these trades, because we understand that the higher time frame is going to be giving us a bigger picture. The higher time frame is going to be telling us what's more than likely going to be happening long term. So we may have a small move lower today, but that doesn't mean that we're overall bearish. That doesn't mean that the monthly chart and the weekly chart are bearish now, because you always got to understand what is happening overall, what is happening on the bigger picture. If you can understand the bigger picture, trading each day is going to be easy, because you're going to be moving on it's like having a way bigger plan. Try to think about it as somebody who is looking at, they're planning their whole year ahead versus someone that's only planning their next day. Someone that's planning their whole year is going to be way more confident, and when things happen, they're not going to be surprised because they're going to be prepared, versus someone that is constantly doing it the day before. That's why you always got to understand, pay attention to higher time frames, because the higher time frame is going to be what really tells you what you need to see. So now, how do you use the higher time frame with fair value gaps? Simple. I only look for fair value gaps on the 1 hour, the 4 hour, and the daily. Those are the only ones I look for. When I'm looking to take a trade, I'm only looking on those 3 time frames. If I don't see a clear fair value gap, if I don't see something very clear, I'm not going to take it. There's no point. So what is an example of me doing this? So I took a trade right on Wednesday. If you guys want, let me see. Yeah, I have it over here. So here, I'm going to send it inside the little chat on iMessage. This is the one from Wednesday. And the main reason that this trade ended up going stupid was because at 2 o'clock there was a news. Like I told you guys, there was news. But as you can see, what do I tell you about timing? Timing has volume. Like, mind you, we're on the hour chart. So if we're looking at this right here on this day, Wednesday, price was barely moving from 12 a.m. all the way to 1 p.m. And then what happened? When the news came out, all that volume was in there. The only thing that you got to be careful with trading any news event, though, is the fact that you can lose very fast. It could all go downhill very fast. and is putting yourself in an environment where you're more likely to lose a lot of the time. So that's why I personally don't like to trade news. The only reason I was even trading it was the fact that I was already in it from all the way earlier in the morning. But once that happened, it was crazy. But what was my reasoning behind this trade? Because you guys may have seen it wasn't really a false break move. It wasn't running an old higher low. And the move I'm talking about is right here, right in this. This is the area that I want you guys to pay attention to. Why? Because the time it happened. What time did this happen? Did this drop happen? At 9. So more than likely it happened at 9:30. But we didn't run an old higher low. So what was my reasoning for taking this trade? This high right here. And what would this high be? If we go to, do you guys remember the time frames I said I only look for fair value gaps on? 1 hour. What else? It was 2 more. 4 and a day. So with the 1 hour, 4 hour, and daily, those are the only time frames I'm looking for. I keep it simple. So right over here, where is a clear fair value gap that you see? Right here, right? It's very clear. It's the only one even in this area. That's why I want you guys to use higher time frame, because it's going to make it very simple. If you're on the 15-minute or the 5-minute, you're going to see 100 fair value gaps. How are you going to know which one to trade? This is on the 4 hour. So I went from the hour, which was like this. So let's just put an example. Let's just say I'm looking at the chart just like this. On the same day. As you can see on the 1 hour, you can see 2 gaps right here, right? You have 2 of them. But now you got to understand which one are you going to trade now? Because if you only have one trade, you can't trade both of these fair value gaps unless you have a really, really wide stop loss. Because say, for example, you wanted to trade this fair value gap. This one held on the 1 hour. Why? Because this first candle, second candle, and the third candle, they left the gap in between. So the first and the third never touched. If you draw those over, it leaves this gap in price. And as you can see, look at how price held this area. This is what I want you guys to understand, that this is not random. There's a reason that look where the bodies closed. They closed literally above that fair value gap, right above it, right above it. Also pay attention to how these wicks came down and filled it in perfectly before going the other direction. Now, you got to understand, what was the reason to trade this one versus the fair value gap that's right below it? Because that's a valid question. It's a very valid question, because you could easily say that price came all the way down and tapped into this fair value gap and then went higher. Or you could say that it went and filled this one. So what is the key? When you see one or more, if you see 2 fair value gaps or more, likely I would try to go to a higher time frame and slowly creep your way higher until it gets simpler. You don't want to overcomplicate this. I'm telling you guys right now, you don't want to overcomplicate trading. It may seem complicated at first because you're intaking a whole bunch of new information at once. But once you're doing the same thing for months and months and months, you don't want to overcomplicate it. You want to have a system that's going to be easy. So if I go in the 1 hour and I see 2 fair value gaps or more within the area that I'm kind of watching, because the main thing is, what are we doing before anything? Before we take a trade, what is the one thing that we're making sure is aligned first? Not the chart essentially, but it's an aspect of the chart. Think about what the chart is. The chart is price and what? Time. I kind of gave it to you, but I'll let you have it. But what was I gonna say? So you gotta understand that we're only coming to the charts at a certain time anyway. So if we're coming to the charts at 9:30 and we're only, say, right here when this happened at 9:30, there was no reason for me to think that I was gonna get a move that was gonna come all the way down here. When you're trading within your time, you want to look where you are. If we're all the way up here, I'm looking everything to the left and to the right of like what's currently happening. I'm not looking 2-3 days ago unless there's a reason for it. But for the most part, you want to look at what's going on like this close. This is where the information is. Like when I'm looking at the chart and I'm looking at what I'm looking to do right now, I'm not looking at anything that is too far, because there's no need. There's no need to. That's why we have the higher time frames. So like I said, if we saw that there was 2 fair value gaps here, we were asking ourselves, okay, I only have one trade. Which one am I going to take? Am I going to take the lower one? Am I going to take the higher one? One thing you could do is, like I said, that's why I have multiple. I have the hour, the 4 hour, and the daily. If we come down to this daily now, we go to the same area. That same area that we had now only turns to one fair value gap. So see how it simplifies that same area, but it gives you less to look at. So now you only have one gap. So now look at this. You take that fair value gap, you draw it over. Now you can see based off the higher time frame, see how in the higher time frame it looks even cleaner. Price came down, filled this gap, and immediately reversed. That should tell you a lot, because what is it doing? Remember the analogy I gave you with paint being filled on the wall? Say you have a white wall and you're painting it black. The first layer you do is not going to be perfect. You're still going to have white specks, right? So you're going to keep painting over multiple layers. That's the same thing that the market is doing. When it leaves these gaps behind that are a form of liquidity, price is going to come back, try to fill it in, then keep going. Come back, try to fill it in, keep going. So right here, price had a push higher, left behind a gap. So it came to fill that gap to make it nice and even to keep going in this direction. And it makes it very simple looking at it on the 4 hour, because now when we go down to that 1 hour, look at it like this. Just like that. That was the only thing. So remember what I told you. What is the easy way of identifying whether you should be a buyer or seller? What was the previous day in this case? So this day. Will this day be bullish or bearish? Bullish. So meaning coming to Wednesday, I have already know I should be looking for longs, right? So now I know I'm looking for longs. What's the next thing I would do? Wait for what? Time. So right here, I waited for what? Ideally 9:30, which is the time I come to the charts for the most part, that 9 a.m. So right here at the time, where was I in price? Was I at an old high or low, or was I at a fair value gap? Fair value gap. And then what did I do? I took the buy at the high probability area, which is only one or two things: either running an old high or low, or we're filling into or tapping into a fair value gap, because both of those are two forms of liquidity happening at the right time, meaning we're going to get volume. And look what happened. You catch a trade like this, and like I showed you guys, you can see me actually take the trade. Was this recorded live? I definitely, yeah, this is the one I had recorded live too, so I had the whole clip on it. So just understand that it's very, 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 very replicatable. Very replicatable. You just got to understand the concept. You got to understand what to look for. You got to get your experience. You got to get your feet into the game. But that's why you guys have these demo accounts now. So with that understanding, fair value gaps and false breaks is going to be something I'm probably going to be going over every single time with you guys. So I'm not going to put too much emphasis on it today. I want you guys to get some new information. But what we're going to be talking about new today is going to be the Fibonacci. Do you guys have any idea what the Fibonacci is? Have you watched the course part of it yet? You said a math, what is it? Yeah, so essentially the Fibonacci tool is just measuring a retracement. Do you know what a retracement is? A retracement is essentially when price has a move higher or lower, that one leg that comes back. So basically, you know how people be like, wait for the pullback or buy the dip? The dip is essentially the retracement. So basically, say for example, Bitcoin flew to the moon, right? Instead of buying at an all-time high, you would ideally want to wait to buy the dip or buy the retracement, because there's always, what goes up has to come down. So when it comes, and that's, now keep that in mind. What do you think the fair value gaps are? Fair value gaps are the areas that is coming into when it's having that dip. So people like us, we're really able to buy the dip. You saw that move that I just showed you right here? I was buying the fuck out the dip. Think about it. But basically, is just buying a retracement, and the Fibonacci is just basically telling you what is the percentage of how low it's going to drop. So if I were to say, for example, pull the Fibonacci, the way you pull the Fibonacci is you always pull it from the higher low of the move that you're looking at. So in this case, I drew the Fibonacci from this low to this high. Let me get rid of this. See these two red lines? Is it clear for you guys? But you can see these two red lines. So basically, I drew it from this low to this high. And the two red lines are basically where I expect it to come back. So then in the Fibonacci tool, you can play around with the levels. But the main thing that I have is I have the 62 to 88%. So what does that mean? That means from the move that I drew from the high, from the low to the high, it's just going to give me 62%, 88% of that move. Because it's just measuring the move that I drew from 100%. So how would I use this on the actual chart? The one thing that I like to do with the Fibonacci is I like to draw it from the previous day's highs to the previous day's lows. So it's like the same thing. We're always using the same areas. So in this case, I'll draw the fib. If we're bullish, I will start from the previous day's low. So I will draw it from this low all the way to the current high. So in this case, where did I draw it from? I drew it from the previous day's low all the way down there. And I drew it to this high right here. And why did I draw it to that high? Because if I was coming to the charts at 9:30 and I was expecting price to go higher, I'm essentially looking for price to drop low enough so that it could start actually going higher. So in order for me to do that, I got to understand how far is it going to fall? What percentages are likely to fall? So when it comes to the Fibonacci, I only have two types of fibs that I'm looking for. It's either I'm looking for a deep retracement. So basically, just like I said, what are we looking for when we want to get good trades? People want to buy the dip. They're going to wait for it to dip low enough to where they can get not the best entry that they could have had, because think about it. With Bitcoin, nobody's ever going to get that perfect entry again. You can only get the second best, the third best, the fourth best, but the what's next best. You get what I'm saying? So in this case, the next best would be deep into that 62 to 88%. So when you guys have the Fibonacci tool, these are the settings that you could just have, the 62 and 88. This is just one of them. But when I'm looking for it to come that far down, that's essentially looking for a good pullback. And when it does that, it's giving you the best chance of being able to catch those reversal moves. Why? Because you're basically just buying low and selling high. That's all you're doing. The Fibonacci isn't a special tool. All it's doing is just kind of giving you a visual for your eyes. It's kind of just giving you something to look at. So, because I can easily say, oh, that's 50% of the range. But if you have a tool that shows you where the 50% is, it trains your eyes better. That's why I love the Fibonacci. The Fibonacci is one of the only tools I've been using the whole entire time I've been trading. And it's because it doesn't give you any advantage in the market. I wouldn't say it doesn't give you any advantage. It doesn't give you any, what's the word? I'm trying to think of the right word for it. Any competitive edge, if that makes sense. All it's doing is kind of enhancing what you're looking at, just a better understanding of what's going on at this moment. So like I said, I have two fibs that I like to look at. I have this one, which is the 62 to 88%, but then I also have one which is the 38.20%. And what is this? This is my continuation fib. And where do you see that red line right now? Right where it's touching, right? And remember what I said about yeah, you see that smile. You saw 38.20%. So basically, what is this? Why is that line there? Because like I said, exactly. That's the main thing. And there's a reason behind it though, because mind you, this isn't only the fact that it's a 38.20%. We also know that the fair value gap was also there. So this is a double confluence at what? 9:30. That's already three confluences right there. And if you want to add the fact that the previous day was bullish and you were looking for buys, that adds maybe a fourth confirmation. But we understand the Fibonacci isn't a magic tool. All it's doing is showing us where price is likely to retrace to, I mean. Where is it likely to have its pullback to? Because we understand that in order for price to go higher or lower, it has to go up and down. What goes up has to come down. What goes down has to go up. It's just how the market works. It's the same reason why we're able to catch those false break moves. When price runs above an old high or low and then drops, that's essentially what the market is doing. It's getting ready to have those pullbacks. But in this case, the second fib level that I like to pay attention to is at 38.20%. And this is a continuation fib, meaning when price is really, really strong and it doesn't really want to have deep pullbacks, is likely to retrace to this area a lot of the time. So with the fib, I only have those two types of levels, the 38.20% And then I also have the normal one, which is the 62 to 88%. And whichever one it trades into, that's what I'm going to be taking the trade off of. Ideally, I'm looking for the one that has multiple confirmations. So in this case, if I'm paying attention to time, like I said, was it more likely the price hold that 38.20% level that was already all the way up here at 9:30? Because the main thing we want to pay attention to is where are we at the high probability time. That's the main thing, because at 9:30 I could have been looking at maybe this fair value gap all the way down here, right? And maybe I could have been looking at the not the 38.20%, but I could have been looking at the other fib from the 62 to 80 to 88%. I could have been looking all the way down here. But the main thing that's keeping us from waiting for that is the fact that right now, at the high probability time, like we're at that time right now, this is where we are. We're not down here. If it would have dropped in a couple minutes, it would have changed. But where were we at that time? That's the main thing, because that's what I want you guys to understand. Time is everything. When that high probability time comes, you want to pay attention to where you're going to be going in the next 15, 20, 30 minutes, because that's going to give you the best idea on catching that good trade, because you're already in that high probability time. You're already positioning yourself in an environment that you're likely going to have the volume anyway. So basically, this was the reasoning behind the trade right here. That 4-hour fair value gap that I explained to you guys. Now I also explained the fact that I was also looking at this fib. So this just adds to the things that I'm looking at that you don't necessarily even see. But for the most part, the main tools I use on a daily basis when it comes to like taking trades, like the main things, I use the Fibonacci. I have like my little trading view markups, but those are things that you could just kind of play with yourself. Everyone's gonna have different markup strategies. Everyone's gonna have different chart strategies. Trust me, my charts were never this clean before. Trust me, the last probably year, that's when they cleaned up. Before, I always had different stuff. I'm always trying different things, but that's fine. When you're learning, it's gonna be cluttered because your charts are gonna represent your mind right now with all the different information. Cluttered as fuck. So we have the fib I use every single day. When it comes to next, I use the understanding of liquidity, and that could be in the form of fair value gaps and also old highs and lows. What else am I using? And 3, what's that main thing we like to use? Time. Time is everything. And honestly, is there really a 4? Liquidity, old highs and lows, time, the Fibonacci. Those are really like the main top 3. Everything else can kind of fall into a subcategory of these. But when it comes to every single day that I come to the chart that I'm looking to take a trade, I need to have an understanding of using my Fibonacci, which I've mastered by now, because before I understand liquidity, I understood the Fibonacci. Yeah, I learned the Fibonacci long ass time ago. And these levels I've played around with the levels over time, and the ones that I have right here are a good median of what likes to work. That's why I have the 2 types. I was able to experiment with them over time. So we have the fib, understanding liquidity, which is in the form of fair value gaps and old highs and lows, and time. If I always have those 3 confirmations together, time matching with a good fib, matching with a fair value gap being filled, or running an old high or low, if we can kind of get 3 of those 4, if we can get all 4, yeah, that's where you got to start putting a little bit more risk, because you got to understand where you have an edge, where your probabilities are highest. If you have a 99% chance of winning, you going to bet the whole house, because you're like, what's the chances I lose? You get what I'm saying? Versus if you have a 50% chance of winning, you're like, let's just test the waters. You know what I mean? It's all about confidence. It's all about knowing what you're good at, knowing where your strengths and weaknesses are. Oh, shit, I forgot. I had this camera back there recording. Oh, man, this is going to be too much game. Camera hot as fuck. But what questions would you guys have so far? Just make sure I know you guys are going to have a couple questions, so. Matter of fact, I'm not even going to ask you. Do you have questions? I want you to ask me a question. So you guys got like a minute. I'll let you think. Think of some questions you have for like what I was just explaining. because if you got questions, it's only gonna make you brighter. All right, let's see. Amanda, you go first. What questions you got? All right. Now, yeah, we gotta put it into live action. What about you, Anna? You got any questions about the Fibonacci, or you're an expert at it? All right, say no more. Say no more. I'm trying to think. I want to see what else is necessary to get you in the market. I may just go over more of these these trades that I took to kind of give you a real time example of me using the concepts as a form every single time, every single week. Because mind you guys, this trade happened with the same fair value gap concept that I was talking to you guys about before this day even happened. So understanding that what price does the same thing over time. And you want to know what's even crazier? Before this move happened, did you pay attention to what happened before that with the previous day's high? Right up here. The same concept. But this was a false break. Price ran above the previous day's high, which was also the Asian session high. It also had the 3 a.m. high over here. So what do we know when there's multiple highs or lows in the same area? It's stacked up orders. So there's going to be a higher chance that price is going to have those false break moves. And as you can see, this happened at 9 o'clock too. This like whole candle, a lot happened in this candle. This candle ran the high and dropped and then came into fill this fair value gap and then pushed higher. But this example we went over for the most part. I want to go over where was a good one? Right over here. Here's a good example of a false break. So this was last Friday. I might have went over this with you guys, but we'll just keep going over it because nonetheless, you just got to understand how the concepts work. Right here, at what time did this happen? This happened at 8 a.m., but I'm pretty sure this happened because it was news at 8:30, so that's why we had a lot of volume in this case. But price did what? It ran below the previous day's low, which is a high probability low. High probability low. That was a tongue twister. But we know that the highest probability highs and lows are going to be the higher time frame, the previous day's highs and lows, the weekly highs and lows, the monthly highs and lows. If we can get good runs of those highs and lows at our right time, at our ideal time that we want to be in the trades, is going to be a very good indication of where we're likely to go. And the main thing that you always want to understand before anything is what was the previous day's trend? What was the previous 2 days trend? Because if the last 2 days were bullish, the chance of having that third bullish day are more likely. If yesterday was bullish, the chance of being bullish today is more likely. Vice versa if it's bearish. So this was an example of a false break move. Let's go to NAS 100 because NAS 100 I did have a trade also. So right over here, what time did this happen? You see this at 9 o'clock? Okay. I want to test you guys. Look left from that candle. What do you see? Matter of fact, look left from the wick, not the full candle. Yeah, they were struggling, but more or less, I want you to pay attention to a certain area on the left because the one thing that you always want to understand is when you come to the market at a specific time. So what time is this right here? This candle? 9 a.m. So that's the time that we would have been coming to the market. What was the previous day's trend? Bullish. So if it's 9 o'clock, 9:30, we're looking for longs. Price already looks like it's dropping, right? But what do we know about the market? For price to go higher, it's going to need to come lower first. It's not always going to do it because it may sometimes be not ready to keep dropping, but you got to understand a lot of the time price is going to have a pullback of some sort. How are we able to measure where price is likely to have a pullback from? You guys know how? not fair value gaps. It starts with an F. The Fibonacci. So where do we like to draw it from, ideally? Or at least I like to draw them. Previous day's highs and lows. So if the previous day was bullish, I would start from the previous day's low, and I would draw it to wherever the current high or low is. So in this point, it will be all the way up here because that was the highest. I wouldn't say current, not necessarily the current would have nothing to do with the time frame. It would have to do with the price swing that you're looking at. Because if I were to go to, in this case, the 4 hour, it will still have those two highs and lows. If I would go with a 1 hour, it's still those same two highs and lows. But it's just understanding where are the highs and lows for that move that you want to see the retracement of. So if you want to see how far price is going to go lower, you got to understand, you got to measure the first move from this low to the high. And then based off of that move, that's going to give you the percentage that is likely to retrace. Is it going to retrace 38.20%? Is it going to retrace that 62 to 88% and then go higher? That's all the Fibonacci is kind of showing you. It's just showing you where to kind of point your eyes to. So in this case, as you can see, it held this 38.20% level. In this case, it did come a little bit deeper into it. It came about 35 points deep. So that probably would have been a risky trade. But now you got to understand, what is the other thing that we're looking at? Because we're not only looking at the Fibonacci to take a trade. The Fibonacci is just kind of a tool. But what are the two things that we're looking to happen at a high probability time? We're looking for price to do what at a high probability time? We're going to want to look to see if price is going to run an old high or low at our right time, or we're going to want to see it trade into a fair value gap. So in this case, if we're on the hour time frame, we can see that there's a fair value gap right here, which is, how do you see a fair value gap? You look at the 3 candles. If there's a gap between that first candle and the third candle, then it's a fair value gap. In this case, look at this low one right here. And mind you, like I said, when you're looking for fair value gaps, keep it simple. If we're right here right now, there's no need for me to be looking all the way down here. I want to look left from where we are at the high probability time. That's why trading at the high probability time is very, very, very beneficial, because it keeps us looking at the right information, because price has already got to where it needs to be. We let that part already happen by simply being there at the right time. So as you can see, at this time, price traded into this gap here. But what was saying that price wasn't going to just trade into this gap up here? It's a very similar situation to what we were looking for before. Even though both of them kind of still held, you always want to understand what is going to be the more high probability move. What is more likely to happen? And the way you do that is understanding higher time frame. So now we come over to the same area, and now we have what? This fair value gap now is a little bit different, but it's a higher time frame fair value gap. Now if we go to the daily, we also see that there's this daily fair value gap. So this is likely the previous day's high. I'll make this daily fair value gap a whole different color just so you guys could see the difference in it. I'll make it, I don't know, purple. Yeah. So we'll go down to the 1 hour now. So all in this area, all the way down here. Wait a minute. Okay, that daily fair value gap was from a whole different day. What the fuck? Did I draw it on the wrong day? Hold on. That was my fault. I think I drew, yeah, okay. I drew it from all the way down here. The area we were supposed to be paying attention to was right up here. So what happened? If we pay attention to the fair value gaps, where do we see, where is a clear gap? Right in here, right? Because we know that when you see big candles, a lot of the time, those are going to be ones that leave major gaps. And I'm going to give you a little tip. Remember how I said when there's large gaps like this, you don't necessarily want to really try to hold them like that. Why? Because it's such a big range. Because it could either tap into it or it could try to fill it. In my experience, when you're trading large fair value gaps like this, I would rather see it just tap into it. Because there's a very low chance that price is going to come all the way down here, try to fill it in, and then reverse. When it's large like this, a lot of the time it tends to just tap into it. But if you just want to keep it simple, look at this 4 hour fair value gap right here that got filled. It's the same one that was on the 1 hour. It's just on the higher time frame. So what is higher time frame? It's giving us higher probability. So when you look at it from this perspective, you see that right here at 9:30, which is time, we come to the market at the right time. We saw that at the right time, price was having a pullback into a higher time frame fair value gap, and it was also holding that 38.20% level, which shows that price has a strong likelihood of more than likely continuing to go bullish. Why? Because the previous day was bullish and the previous day before that was bullish. We're already bullish. We're trading at the right time, and we're in a high probability area that if we were to go higher, this would be where the best point would be. So if we're wrong, we're wrong. If we're right, we're right. In this case, I took the trade and it was right, and it continued to go right for the, I'm still holding the runner right now. But the whole idea and concept was price had a move higher from the previous day. And then when New York session came around at 9:30, we happened to be at that 4 hour fair value gap. And we also happened to be at that Fibonacci level. So with all that said and done, once price was there at the right time and we already had the trend, all I did was simply execute on what I was seeing. I bought at the area at the right time, and then it just kept going. But the concept is the same. The reason I took the trade is the same reason every single time. Every time I take a trade, it's more than likely for the same reason. It's either filling a fair value gap, tapping into that fair value gap, or is running an old higher low. But the main thing that is keeping all of these together and is keeping all of these doing the same, like the all one main trait, is time. No matter what is the reason I'm getting in or out, I'm trading at the same times every single day, because I know that if I trade within those times, the likelihood of me winning trades and being able to be in good trades is going to be far more likely than unlikely in those situations. But yeah, so those are the main things. Like going into the market this week, if you could start like really just implementing, understanding the fair value gaps, paying attention to the higher time frame ones, understanding where high probability previous days highs and lows are, if you can understand all those things and start putting them all together, just like I'm showing you guys right now, just if you have multiple confirmations, if you see multiple of those things align at once, just take the trade. Just put yourself in that environment to take the trade. Once you see them all, even if you're not sure if you're actually accurate on what you're seeing, take the trade, because if it plays out, you're going to think you did something right regardless. So it's not really going to matter what you thought beforehand. You could do something fucking wrong. If it wins, you're going to think you did it right. I already know it's going to be like that, but that's why you got to get into it to start feeling it, because you got to do it multiple times. Because if you do it one time, the first time, and it wins, but then you do it another 10 times and then it loses the next 10 times, is more than likely not something sustainable. But that's why you just actually got to get into it, start using it so you can see where the strengths and weaknesses are, so y'all can come up with some fucking questions. Because I'm telling you, you're going to have questions. You're going to be like, damn, I thought I understood. That's what I'm saying. You, like, a lot of the time, there's always a reasoning behind it, because even though it may look like I'm buying a higher low, there's a reason that that is a higher low, and I already know that. We're either running a higher low, which makes basically the way all my trades essentially look the damn same. I'm in at wicks regardless, but that's because of the way I like to catch trades, the ways that I understand the market moves. If I didn't know price was likely to have a reversal, like really think about it. Every single trade I took was going the opposite direction when I took it. Every single one. But I had a stop loss in place, so I essentially knew it wasn't going to go lower than a certain point. You could call it magic, but you know, I ain't going to give myself that. But and it's experience behind that at the end of the day. That's really what it comes down to: experience, understanding, intuition. Because the more chart time you get, you're just gonna start seeing things. You're gonna have a better understanding of what's likely to happen. Like, just trust me. Just trading you is gonna be your best friend. I'm starting to look into other, because I don't know if you guys know, But there's a whole bunch of stuff with like MetaTrader and like unregulated brokers. But I'm looking into other platforms and stuff for trading because there's a whole bunch of ones already. But I'm looking for one mainly sustainable because I don't like switching. But the main reason I'm probably gonna be switching is because the broker I've been using is like Osprey. They're moving from MetaTrader to TradeLocker, and I don't really fuck with TradeLocker. But I know there's brokers out there that we can trade specifically from TradingView, and that's what I'm really trying to find. Because if I could take all my trades and do my markup on TradingView, that will be the ideal. Because TradingView, I've been using them since I started trading too. Like regardless if I use MetaTrader or a different platform to actually take a trade, I'm always using TradingView. So if I could take my trades on TradingView and just have it all in one spot, it would make it easier to teach. It'll make it easier for me to trade, everything. But that's something. Not even that. Like if I were to go to like where is this? If I were to like these aren't even technically sponsored. These are a lot of the times these are regulated brokers. So these are ones that they actually like are allowed. So that's like one of the main things I've been looking at is Tradeovate. Tradeovate is definitely one that I'm thinking, because if I could trade it on here, it'll make everything very easy, especially for teaching. But it's just having it all in one place. But nonetheless, the skill set's the main thing. All these platforms and things, it's like banks. They're gonna be around regardless, because majority people that trade, they don't make money. So it's always gonna be a space where people are gonna come to look to try to make money off them. So that's why I ain't really too worried. It's just about finding something sustainable, because I don't like switching from broker to broker. I use Osprey past 3-4 years, so. But we go find something new. There's thousands of other options. Now, yeah, I got y'all. Right now, y'all can still just use FTMO. The FTMO is fine. That's why I really put you guys on it anyway, because that one's the most likely to keep MetaTrader for right now. But even then, it's like still, I'm not 1,000%, because it's not like they've said anything on it, though. You know what I mean? But they still got it, so we just going to do what we got until we have to. But y'all have any other questions though before we get up out of here? Shit, we gonna see when y'all getting these charts. Y'all gonna be like, yeah, I see the questions now. How to take 7 losses in a row? Oh man. But for that being said though, I'm gonna talk to y'all. Appreciate y'all for being here, allowing me to speak my truth with 3 hours of sleep. I'm wide awake now. I have a Red Bull. I'm gonna go drink it. Not always, but just let me know if you guys have questions. You have my phone number. Also, just go through the course too. Everything that I've been going over is all in the course, so you'll be able to get like extra videos on it, like inside of it. Like probably, if anything, I might explain it a little bit dumber down in the course for a lot of the concepts. So if you want to look into those, you can do those too. Trust. But for the most part, you can start going through the whole course too. Like there's not really much in there that you won't be able to start grasping now, if that makes sense. But I'm gonna talk to y'all. Y'all be safe. Enjoy the weekend. Today's Saturday. I thought it was Friday. Fuck it. But yeah, I could tell this shit looks trash out, bro. I usually leave my balcony door open. And I had it open and I could just like smell the rain. And that's trash. All day. That's crazy. It's only 10 a.m. How long you been up? 6 is crazy. I went to bed at like 4. Nah, yeah, that's shit. Look at me. I didn't have to be up. But I like to, even though the market's not open, I still get myself here at 9. It's just practicing. Yeah, it's all about routine a lot of the time. It's all about doing the same thing, putting yourself in, just having a system that allows you to keep yourself from making yourself fail. That's really what it comes down to a lot of the time. Beating yourself. But I'm gonna talk to you though, bro. If you need anything, you got my number. But you be safe.